You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Wednesday. Kind of ironic, but I discussed investing with one of my DSR members the other day, and he came with those 4 words that are quite interesting because they are super simple, but they summarize a very successful strategy, which are research, buy, drip, and forget. So let's take a deep dive and let's discover if it's that simple to invest. Because sometimes investors are telling me, Mike, you're trying to simplify something that is a lot more complex. And after 21 years investing in the market, being 100% invested all the time, always in stocks, I don't think it's that complex. I think that we like to think it's complex. We like to think that we need like 5 Excel spreadsheets and 50 ratios and then read like 200 pages of analysis. But investing is not that complicated. Is it that simple that you just have to research, buy, drip, and forget? Let's take a look at it. So, of course, research. Research is probably like the most important word in this strategy. It refers to do your due diligence. And what I mean by that is you cannot just read an article, listen someone on the podcast like me telling you how much he loves National Bank and just open your brokerage account, buy National Bank, and call it a day. That doesn't work this way. It doesn't work this way because if you don't know what you buy, regardless if it's a stock, if it's an ETF, or any other investment product, if you don't know what you buy, you're just walking blindly into your investment journey and you don't know what's going to happen and you don't even know why it's going to happen. So when I invest in National Bank, I know there are some risks. I know that it is a Quebec-based focused company, that if the Quebec economy goes down, like a big chunk of their business is going to suffer. I know it's a small player surrounded by big guys that have a lot more financial means, and they could enter into the national banks market and compete against them, and it's going to be a rough ride. I know that they're taking additional risk by investing offshore, and maybe their adventure with ABA Bank in Cambodia is going to turn out to be a disaster. So you need to understand the type of risk you are willing to take. That's pretty much what making your research means, is every investment has risks. Even if you buy bonds, the risk is you're not going to get a high total return, which is all right because that's the price you pay for safety. But if you don't know that and you expect that you buy bonds and you're going to average 8%, you're going to be disappointed, right? So the research is super important. And then you just buy. The buy period should be quick, swift, fast, with conviction. So spend more time doing your research, spend more time understanding in what you invest and why you invest. So it's like the good old Peter Lynch quote, know what you own and why you own it. But once you know that, you just buy. Like whenever I get to that step in my investing process, I literally open the brokerage account, and the longest I take is simply to say, how much I have to invest today, what's the stock price at? I have to divide this to find out how many shares I can buy. And that's like the longest point of this step. Just buy with conviction. After researching, after buying comes the drip. The drip is for reinvesting your dividend. Literally, you could use the dividend to buy the same shares. So that's the classic drip, I would say. So just reinvesting the dividend. So you receive for $100 of National Bank. So you buy for $100 of National Bank shares. End of the story. You move on and you keep on. You keep on with your life. The advantage of dripping like this is you put your portfolio on autopilot. You're buying what you already research and what you already like, which totally makes sense. And you make sure that all your money that you have invested works for you all the time. I prefer a dividend type of reinvesting my dividend. It's just that I let the dividend being deposited in the brokerage account until I reach about $1,000. And when I have $1,000, I will reallocate that capital throughout my portfolio. Most of the time, I will use it to buy a stock that is a smaller position or lagging behind the rest of my portfolio, just to balance the portfolio itself and to maintain about the same weight for most of my stocks and to have a good sector diversification. The disadvantage of this is, of course, while I wait, sometimes I wait and then I have over $1,000, and that $1,000 is not doing anything on that bank account in the meantime. So the money is not always working for me. But since I'm pretty hands-on in my portfolio, it doesn't happen that much. But if you're not the type of person that looks at their portfolio and take care of things like every week or month, well, maybe just dripping would solve that solution. So you have both pros and cons, but the concept here is always reinvest your dividend, as long as you're not retired, of course, because once you reach retirement, well, that drip phase is probably gone, and then you have to live off those dividends, so you want to cash them out. But in the accumulation phase, you research, you buy, you reinvest your dividend, you reinvest your profit when you sell a share. Make sure that the money works for you at all time. This is how you're going to benefit from the beautiful power of compounding interest, right? Next, the last one, forget. This one, I'm having a little bit more trouble with this one. Forget. I'm not willing to forget about any of my stocks. Of course, I get the idea, though. The idea is you want to do such a good research and buy with such a conviction that you do not want to touch that stock for years, decades. I mean, every single time I add a stock to my portfolio, my goal is to hold it for like more than 20 years. So it's kind of like buy and forget in a sense, where I would change that for do not worry, but monitor. Because unfortunately, the economy changes, business model changes, competition changes, and you have to monitor your stock. What was amazing 10 years ago may not be amazing today. And that's true for everything, right? So it's not a matter of like going crazy. It's not a matter of letting your emotion in. So that's why you have to forget about your stock. You have to have that level of conviction that you know that what you own is great, that fits with your strategy, that is aligned with your goal, and that you're going to reach your financial goals by investing in those stocks or in those products, right? But then you still have to monitor. You still have to make sure that everything is doing what they are supposed to. If you invest in a company because you like their growth by acquisition model, and they have been super successful over the past 10 years doing this, but now you realize that in 24, they don't make any acquisitions, 25, same thing, 26, same things, and now the revenue and the earnings are not growing that fast, the dividend growth is slowing down. Well, maybe the business cannot find any other great acquisitions to make. And since it was their model and why it was so exciting to have this stock in your portfolio, maybe it's time to revisit and do literally go back into the first step of that strategy, which is research, to look at what's going on. So to circle back to that question of is investing could be as simple as research, buy, drip, and forget, or as I like to say, don't worry but monitor. I think so. This is very, very close to how I've been managing my portfolio for 21 years, and I intend to continue this way because it's literally working for me. So maybe it's not working for everyone, and I know there are multiple strategies, multiple ways to approach investment, and that's fine. But I just like things that are simple, so I do not overthink and waste energy on stuff. So research, buy, drip, and forget sounds like the foundation of something very solid. Of course, as I mentioned today, there are a lot of details included in those 4 words, but if you lead by them, I think your portfolio is going to be in good shape. So, all right, Moose, that's enough for today. Tomorrow, we're going to talk about my worst trade for Halloween because, we all make big mistakes. So, we're going to talk about a little bit more about what happened when I lost $10,000 on a single trade. So, and I was young that time, so it hurt big time. All right, guys, so that's for tomorrow. Don't forget to give me a 5-star rating on Apple Podcasts or Spotify if you enjoy the show. And we're going to see each other tomorrow again. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.